All right. Hello. We're back. It's been a while. I was on vacation and got busy. To anyone that even watches this, but I guess we're just doing this for documentation purposes. I'm not one of those other YouTubers that actually is good on this. So I think that's recording. Right. Well, anyways, since it's been so long, so much stuff has happened since I don't even know the last time, a month and a half. Got some new tariff updates. The market reached an all-time high. Dollar is deflating, which is not deflating. Dollar is getting less valuable, which is just great, But you know, um, with all that said, I'm gonna go over Amazon, which obviously, these big tech companies, oh, they've been covered so much, like there's no way you could possibly find analysis on them, but um, there is ways to find analysis on them, especially with Google. I mean, everyone's beating up Google, and look where it's at now. I think I've had about 20% gain since it's been bashed over the time period. So let's go over Amazon. I don't know if anyone's ever seen. Well, I'm saying this weird. I need to learn some editing, guys. I'm about to fucking kill myself. I need to learn some editing because I keep just stumbling. Um, I don't know if anyone else has seen the way I take my valuations, but I essentially get four valuations and average those out. A dividend discount model if it's applicable. Not to this one though, which now that I'm looking at this, have I even? Oh yeah, yeah, yeah. That's why I use a discounted earnings per share. I recently started using a DCF instead of the discounted earnings per share. Um, I was before when I because I have a few more of these that I've done. But I had a DCF like right here, and I had the depreciate or the discounted earnings per share, and then I averaged those out with everything, and it ended up being way fucking higher, which is not accurate because they're essentially the same thing, except a DCF is more exact because it's just cash, not manipulated earnings. But with Amazon, I used discounted earnings because the cash flows are inconsistent, especially in the phase they're in right now, as you can see right here. This is free cash flow per share, by the way, not just free cash flow. But anyways, I'll get into the valuation. Anyways, and let me know, guys, if this makes sense, like the values that I'm coming up with, because honestly, I feel like these are reasonably conservative, But the way I find my proper price to earnings trading range is just using industry averages. Amazon's in a lot of things, but mainly what I compared it with was software, cloud, and e-commerce. So I have Alphabet here, of course. I have Microsoft, the cloud competitors, and then I have Walmart, Alibaba, and then eBay, which a lot of people are comparing Google to, which is just the most retarded thing I've ever heard in my fucking life. Anyways, I took these instead of just a broad sector because a lot of the times that doesn't really give you a clear picture of where it's at with its competition. So I took these six, my bad. I took these six, averaged it out, found the mean. I took the forward PE, historic PE for the last 3 years, the average, and then I averaged all of those out. We end up getting about 35, and that's where I believe it should be at, appropriately trading at, since it has so much room to expand. It's probably one of the best robotics plays slash AI plays. I mean, and I'll tell you why later in the thesis. But that ended up, I don't know, I need to change this to sell, not sell, but valuation comes last in these type of things. It's more qualitative. We ended up getting 253, which is 14% upside. Um, which this says sell, but it's not a sell, definitely not. So we go to the price to book models and then the Graham model also. I don't know if anyone's seen these, but it's basically you just plug this formula in. Um, I usually go with about 8 to 12 for a PE company, of a PE of a company with no growth. The long-term growth rate I just find from kind of guesstimating revenue, earnings per share, cash flow, dividends also, shares outstanding, how much that's going down, so it's returning value, and then growth multiplier if it's a fast-growing company, which Amazon is still, which it's kind of impressive. As of when I did this, the 20-year average corporate bond yield was 4.93. And this will always stay 4.4 just for easy sake for the formula. Ended up giving me downside, which makes sense with the Graham model because these don't really take into account a lot of other factors like cash or like current price to earnings. It kind of just assumes that it's trading at its true value, that it's not growing ever. Um, and then for an industry multiples model, the price to book industry multiples. I don't know why I'm going over this again. I literally go over this every time. Anyways, I took the price to book, did all the stuff with the return on equity. You can watch the other videos that explains it more, and I ended up getting upside. Great return on equity, by the way. And then Graham's number, this is always just a thing I put over here, which always fucks every tech company because it's never fucking asset heavy, which I don't know why I still have it here, but you know, it's whatever. Depreciated earnings per share. Again, I've been over this a few times. But we just go on the trailing 12 months analyst, find the estimated growth, find its 5 year historic growth, average that out, which has been a little bit hard for Amazon because they did go negative in 2022, but that's okay. We found the 5 year average still. Then we apply a conservative growth and then an appropriate PE, which is honestly, because I said the appropriate PE was 35, so I actually fucked that up. My bad, everyone. Anyways, yeah, it'd be 35. That's what I found as an appropriate PE right now. Um, we project the earnings per share over the next 10 years. We find our discount rate, we bring that back to present value, and this probably should be like 30 something. It's not going to drop off that heavy, but it's fine. We've already done the valuation. We only go off the 5 year, anyways. Anyways, that gives us a huge upside from earnings potential, which the earnings potential is incredible with this one. I'll tell you why. Um, and I've added this new part, which actually I will show you in more videos. But it's just a lot of financial metrics. My friend Mason, shout out Mason, he's watching this right now. Crescendo Capital on top. Um, but yeah, I've incorporated this, which helps me kind of gauge liquidity, solvency, efficiency, um, its base profitability, capital margins, and then baseline growth, which all have been pretty well. And you know, the current ratio is actually surprising for Amazon too. I would not think they'd have such a great current ratio, but whatever. Anyways, as we go to total valuation, we end up getting intrinsic value of 285, which is 28% upside. We discount it by 10% because I'm always fucking wrong. And we get about 15.5%, which is still a buy in my books. It's above 15%. Analyst ratings, which, as I said, there's a ton of analysts covering this. So you have a buy, 4 hold, and 0 sell. Um, and yeah, we'll get into the thesis now. So on a cash flow yield basis, it doesn't look nice right now, obviously, because they're investing heavily into AI infrastructure. Another one, Arista Network, shout out Arista. But they're investing heavily into AI infrastructure, which is why the cash flows have gone down, but with good reason. Um, it's justified by their heavy capex spend. While Amazon's harder to predict cash flows, it can make up for with excellent growth and dominance in the e-commerce market, which it already has. Alibaba and eBay are, you know, they're pseudo competitors, not really even there. Well, Alibaba's kind of there, but it's Chinese, so you know, China's getting shut off a lot from trade, but that you know that could change. We've had consistent earnings per share growth over the annualized 5 years. Revenue continues to see excellent growth, and it's accompanied with ever increasing return on asset. Since they are mainly an e-commerce business, which is about 66% of total revenue, inventory ratios are going to matter significantly more than other tech companies. Um, you know, and I said it might be advantageous to do a by parts dissection, but I didn't because I'm fucking lazy. Um, anyways, yeah, I just plot these on here for my reference. Jesus. 1 second. Technical difficulties? Okay. Anyways, I'm not even gonna read off this. I don't even know why I'm doing this. Anyways, the reason that I think Amazon is so great, and I actually put it at the bottom. Holy fuck, I wrote a lot on this. Okay, I'll go over that later. Anyways, the reason that it is so much qualitatively more appealing now is the idea that it has robotics in play, and I'll tell you why. If we take a look, I have to bring this up. Fucking lazy piece of shit, and I didn't have anything prepared. Holy fuck. Anyways, we look at profit margins. Wrong. Anyways, we look at profit margins of 10% and then operating margin, which is higher than the profit margin, which isn't always good in every case. It shows kind of inefficiency, but um, we have these lower margins compared to the other tech companies of like Google and whatever, mainly because of e-commerce, right? And all the labor that goes into packaging and the fulfillment centers and then the drivers. And now, what if I told you that AI can change that entire thing, which is why they're investing so heavily, which I agree with, into this type of stuff. If Amazon can pull off cutting most of their labor, I think they employ 1 million people or something close to that. Hold on. Holy fuck. Okay. 1.5, well, I thought it was less than one. We're gonna go with just US. 1.1 million in just the US, and then 400K in other places. If they can cut down more than half of that due to robotics and AI, and the reason they couldn't get the robotics going right now, like self-driving or discerning when they're picking apart the packages, like discerning those type of things, the reason they couldn't do that is because the AIs don't have a, or their robots didn't have a brain yet. It's just like it can use sensors, I guess, but it can't tell like if this one is a little bit dented or if this one's a little bit that. And AI totally changes this whole thing. And if they implement that into fulfillment centers, into driving, they eliminate, which obviously this fucking sucks for the workforce. It's great. I love it. It always comes at a cost. But, but, if they eliminate half of that workforce, margins go up exponentially because that's where all of their costs lie mostly right now. If we take a look at the financials. My God, it's frozen. Anyways, where's it at? Yeah, they don't really classify it, but it is going to be in operating expenses. And holy fuck, if we look at, I think it's this one, selling general admin expenses, I'm going to go, I believe it is the bulk of this is labor. $156,000, not 156, 156,000 times million. Fucking, what is that? 150, 15.6 billion. If that is cut off of Amazon's expenses and revenue is maintaining, not even fucking going up, maintaining, or even lowering, it could lower. If they cut half of this, the margins go up so significantly, they make so much more, they return so much more value since they have that good equity base. And the stock price will follow the business. I mean, really, with these things, you're buying the business, not the stock, like Warren Buffett said. But if you buy into the business now, it's like the future potential for expansion and growth, and then margin cutting is it's right there. It's perfect, which makes you think, oh, well, why are people against Amazon? Well, I could come up with a few reasons. Let's go right here. I could come up with four. Anyways, here are the concerns. High operating expense relative to income. Um, the high operating expenses can be explained by their general business model, which is deep infrastructure costs rooted in. While slightly alarming, it's not really a deal breaker since they have still seen amazing net income growth since 2022's flash crash. So it's not too insane, their operating expense. But again, with the whole robotics thing and integrating AI into it, that cuts that down by like the potential to cut down by fucking, I don't even know. Okay, I haven't done the math on it, but it has the potential to cut down greatly. I mean, if I could replace, if I was a business that had the shareholders in mind, because that's who I'm giving value to, and I could cut costs, that is exactly what I would do. I mean, it's kind of a no-brainer. They don't give a fuck about people. Let's be honest here. We're in corporations. Second one is the possibility of long-term tariffs, which I've kind of ruled this out as even a thing because the market seems to give zero fucks about tariffs anymore. Um, the big orange man, he's getting all riled up, but the market does not seem to care. We're at all-time highs, so who can really say anything about it? This is the most speculative concern, one that I cannot truly predict. I'd like to believe that many of these tariffs now are unstable or unsuitable, which is true. I think I did this before I went on my vacation, so it might have been some of the like no, it was after the China one. Obviously, tariffs are bad for Amazon's core selling business, as they don't have product power like Costco. Merchandisers aren't obligated to pay the tariffs since there's so many of them. While not a union, a general group of sellers could simply sell elsewhere with tariffs aren't in place, which would lose Amazon a decent amount of revenue. However, uh, if I were to guess, I believe that more. Holy fuck, am I dyslexic? I believe more deals will be made in the future that will eliminate or lessen the burden of tariffs. Sorry. Even to a point where if there were any, the sellers are still making massive margins. In that case, consumers pay, which is great. And then Amazon's revenue stays intact. And then the third concern was competition with Azure and Google Cloud, except I know that AWS has seen great growth. It's a little bit hard to see here. Here, maybe I can actually go here. Yeah, but let's just look over the past, say, what are we in quarter two? Quarter three, technically. 76.5 bill, 80 bill, 83 bill, 85 bill, 87 bill, 90 bill, 94, 98, 103, 107, 111. Don't know what exact growth that is, but I think it's around 4 to 5%. Uh, could be maybe on 3 on the lower end. But still, great growth from a cloud business, not even their core business. They expanded from e-commerce, which is always great to see that they're going out. Um, and I don't think there's ever going to be a time where data storage and user interfaces and stuff like that is going to ever need kind of, I guess, a downgrade or like there won't be ever a non-demand of it. It's always going to be in demand. So I don't see that being a huge issue. And then the fourth part is the unpredictable cash flows, which I already said makes sense right now, as they're investing into AI. But that's definitely the hardest part is I couldn't use really a DCF for this because I have no fucking idea what their free cash flow is going to be. They go all in on stuff. They're not like Google who will keep a good amount of cash idle. They will go all in on it, which is riskier, don't get me wrong, but it does make sense. And if it pays off, it returns huge value, which I think as one of the biggest companies in the world, it will pay off. So, let's see, is that it? Yeah, more risky than Uber. I basically write these things for myself, to be honest. I don't even know why I read off them. It's just like my thoughts right on a fucking screen. Yeah, and as I said, this was after a while. But yeah, based on the qualities of it, it is still undervalued, just on a pure valuation standpoint. And then it also is qualitatively just a perfect company to buy if you are looking for the future of shopping, the future of package delivery, which they dominate in. It is the company to buy, and there's not a lot of bear cases for it besides the free cash flow, besides the possible tariff concern, which really isn't even that big because the market's already pricing that in. And we've seen revenue grow, so really it doesn't even make a fucking difference. Although there's still a pause, so you never know. But yeah, it's like the free cash flow is the concern. The competition with Microsoft Azure and Google Cloud is the concern. Um, Other than that, it's a great play on just robotics and AI in general. So yeah. How long was that video? Let's see. Let's see. How long was that? How long was that? Only 19 minutes? Okay. Let's cover one more thing then. Let's cover one. Oh shit. We'll go over a very short one. A very, very short one. I think JP Morgan's was a short one. I don't think that was too long. Right? Nancy Tolton. Guys, who's that? Nope, that's Amazon. Anyways, yeah. JP Morgan is one of the more recent ones I did. I couldn't use a DCF on this either, which is great. I wanted to show you how the DCF that I'm using works, but I guess I'll just go fuck myself until the next video. Um, but yeah, this is one of the ones I couldn't use DCF for because of the nature of their business. They're highly liquid, so they're gonna move cash flows a lot. Anyways, with JP Morgan, I ended up getting about 12% upside, assuming I'm wrong because I'm always wrong by 10%. It's literally about fair value, with about 14 saying buy, 11 saying hold, 1 saying sell. I want to wonder who the 1 is. Um, might be Michael Burry, I don't know. Jokes aside. Um, the 1 sell, I would assume this is concerns over weakening power of the dollar and uh, also the fact that we have, well, it's not really, that's a statistics thing, but also the fact that we're due for a crash, as some would say. And I also added this little zone thing, which isn't nice. I need to go over this with my most recent one, which is Texas Roadhouse, which you'll see soon. Shout out Joseph Carlson. But yeah, I sold this as a never sell. I mean, it's one of those businesses going to be around forever. They move over $10 trillion daily. Yeah, trillion with a T, not billion. Trillion with a T. Fucking T. Isn't that fucking crazy? Anyways, let's get into the models. Multiples model, I just compared it to banks. Um, anyways, yeah, I just compared it to banks. And what it has, which is literally about the same. We downgraded a little bit, it gives us a sell rating. Not too concerned about it. Um, the trailing 12 months EPS, 20.37. Price earning of a company with no growth is 10, which is, it's been growing, but it also has been around forever. And I assume this growth rate is, I wouldn't put it in the 8, that would put it a bit too low. And I have a long-term growth rate that's on the lower side because it is a bank, which is just literally as more people consume, which is the nature of humanity, it grows. So that's just I feel like this is very assumed. Um, Growth multiplier of 1 just because I don't assume it's going to grow very fast. It's just a bank. And then we had to discount it even more because long-term yields on bonds are going up, which is just fucking great. We're so fucked. Anyways, industry multiples model, price to book. Again, we just took the price to book, which is this part is actually important. We took the price to book of just every bank, have its average return on equity of about 15%, book value per share. We took its 5-year average price to book, which is about 1.7, and then the industry average price to book. And then we also, or will, yeah, obviously we took the industry average. And then we had the S&P 500's price to book, which I should probably be updating this every time I do this because it's probably a little bit higher now. Um, Anyways, yeah, and then we also found its retention ratio just by subtracting um, its payout ratio from 100%. And then we have our justified return on equity, which is, I still believe, around 15% because they've had this 15% for a while and they've had their dividends for a while. Um, and if they're able to maintain that level of return on equity, even when paying out dividends, um, yeah, that's good. This gives us our growth value per share and then our adjusted book value per share. And then we just kind of calculate that by averaging out the two and then multiplying it by the adjusted book value per share. That gives us our price, which is another avoid. We're down. EPS one's always going to be above because it's projecting 5 years out, which, I might have to change my valuations on that, but I don't know. It's okay. Anyways, this one again, we just took the trailing 12 months. Analyst estimate actually is predicting that it's going to go down, which is interesting. Could that tell you something about where they think the U.S. dollar is heading in the next year? Maybe, maybe not. Who knows? Um, I took its appropriate PE ratio from another model we found, the PE model. We project those out. We find the terminal price to earnings ratio. We find the risk-free rate, we find the beta, and then we get our market risk premium, and then we discount it, and then we have a 4 to 6% upside. There you go. And this is the DCF I've been working on. It doesn't really work for JP Morgan. As you can see, we have, what is that, negative, I don't even know. Is that like negative 492 22,963,619%. Yeah, downside is not that great. I think we average that out, we might get fucked. So we're not doing that, you know? As again, their cash flows are unpredictable. And then this is my updated version of it. And we took the 5-year average and then versus the current 5-year average. This is really for me. I don't want to go over and bore everyone with this. But I have these ratios off to the side, which the most important thing I'm looking at here is liquidity. As we see, above a 1 is going to be ideal. This is more than ideal. Quick ratio above 0.5, again, blows it out of the fucking water. Cash ratio above 2.25, which is great. And then operating or interest coverage ratio, which of course they still have, except is that yeah, no, they don't have that actually. Interesting what happened in 2021. Interest coverage ratio. I might have to look into that. Then again though, their operating expenses are transaction fees, foreign fees, salary. I mean, now you're gonna gain a lot of interest. Well, that's not only revenues, interest revenue. But yeah, and then solvency is obviously important, which is great because they're super fucking leveraged because they're a bank. But who's surprised at that? Oh, I'm tired of talking. This is the same thing as before, and I just said I wasn't going to go over this, but I'm already going over it. Um, Asset turnover is great. Revenue possibility is great. Yeah, I can go over this stuff in a more interesting company than JP Morgan since they've kind of been a slow roller. Go back to the total valuation. As I said before, liquidity is the most important thing, and it's all good. They've been on a share buyback spree for the last, what, 12 years? Close to 10, 12 years? Um, yeah, close to 10 or 12 years they've been on a share buyback spree, which is great. That's just returning value to shareholders while increasing their dividends, so they're returning extra share value. As a bank, they should be doing that because they move fucking $10 trillion a day. Um, and then this is also the part that I liked about JP Morgan as opposed to other. Hold on a second. Okay, what is it? No. Fuck, I gotta go to work soon. Anyways, yeah. Market share for them, this is why I like them. They're the biggest bank in the world. About 10.4% market share as of Q1 2025, which has only been growing, actually. If you look in the previous months, it's only been growing. But you know, that's why I chose them, is because they're the biggest bank and they have the best financials in my opinion. Um, Also look at revenue has been going tapering off, but you know, that could be just to the US dollar shrinking. Dividends, again, they've been on a pretty much the same spree since they were here when they started with the shares outstanding and the financial crash kind of killed them because they had to reinvest. But then they've been on just absolute tear and they've been reinvigorating investors. And then look at this fucking look at this cash sheet too. 813 billion for the first quarter of 2025. Holy fuck, bro. You know what I could do with that amount of money? Holy hell. Anyways, yeah, while fairly valued now, buying and holding them is never a bad idea. Definitely because they're a bank that's going to be around forever and is not going to go anywhere. We've seen them survive financial crashes, which gives us a lot more certainty as to how they can survive any type of crash, really. If they survive that fucking crash, they'll be fine, even if they've been bailed out. Which, even if there's a crash in this presidency, they would 100% get bailed out because that is the Republican side is big business. But yeah, my zones are buy at 250, hold at 310, never fucking sell. And right now is at 288, which is still a buy. So wouldn't be opposed to buying it. Yeah, next video, maybe I'll go over a different valuation and maybe a whole portfolio thing. We'll see. Thank you everyone for watching, even though I bet no one watched this, but I know Mason did. Probably not to the end though. This is for you, if you watch to the end. Alright.